Everybody, welcome to the BDO annual budget update. My name is Tony Schiffman, Chief Executive Partner for BDO in Australia, and we're delighted to have a big contingent here today. Obviously this year done virtually, it's a different world we live in, but we're really appreciative that everyone's taken the time to join us today on what is obviously a very significant time in Australia, a massive budget. Lots to digest. I know our BDO team every year works very, very hard. This year was no different. I wasn't up this morning at 4 a.m, but I noticed there's emails at 4 a.m. this morning on the budget publication. A lot of work there, a lot to go through today. The BDO team is here today to talk to you about what's in that budget. So in a moment, I'll introduce you to Neil Billiard, who's leads our tax practice in Australia. He'll be followed on by Mark Molesworth, one of our senior tax partners, who's been very busy today in talking to the media, and then following along with Nicola Purser, who's one of our senior partners in R&D. It's great to see R&D getting a greater focus in the budget this year. And to round that off, I'm delighted and thankful that we got Michael Pascoe, a well-known economic presenter on TV, so everyone will know Michael that well from his appearances on TV. So thanks, Michael, for being a part of the team today. So we will then follow on from that some state-based sessions. So there will be plenty of opportunities for people to ask questions and digest the details. So we'll have plenty of time to ask questions later on. From now, I'd like to hand over to Neil, who might then take it and introduce the team on the budget update. Thanks, Neil.
Thank you, Tony. And just re-echo Tony's words that thank you for all of you for joining us today. I've been doing these budget updates and summaries for the best part of 20 years, and I can honestly say I don't recall a budget that has so much detail and so big numbers in it. So what we're doing today is we're picking out some of the key things that we think will be of most value to our clients, you people on the call, and I will talk about the corporate changes, whether they be big companies or small companies, and the personal tax cuts. We will get Nikki Purser to talk about R&D changes, which are some good news for a change, or some more good news. And Mark Molesworth will follow up and talk about some of the smaller and middle market stuff. So if I can have I've got the clicker, rightio. So, the first thing I want to talk about is the instant asset write-off. So what we have here now is for new capital expenditure, plant and equipment, we can take a full write-off, provided you satisfy a number of things. Firstly, your turnover has to be less than $5 billion. So it's going to be a very large percentage of the economy. The asset has to be purchased after budget day, so after the 6th of October, and you have to have it installed ready for use by the 30th of June 2022. Interesting thing there's no limit on the value of the asset. So this is a very significant change, and when you look at the forward estimates, you can see going forward, 2022, it's about $11 billion, and beyond that, it's another $18 billion. So a very substantial amount of money being put out there by the government. In addition to that, the small and medium businesses, so we're talking now of turnover of less than $50 million. Those of you that watched my video this morning will note that I said $50,000, so I'd like to correct that. A small and medium-sized business is $50 million, not $50,000. Those businesses can actually claim second-hand assets and the same date. So you have to buy it after the 6th of October and have it installed ready for use before the 30th of June 2022. Worthwhile noting that if you fall out of those rules because of the dates, or your turnover's too high, or for whatever reason you don't get the outright deduction, the previously announced write-off of $150,000 still applies, and the announcement in July in the MIEFO statement in terms of accelerated depreciation, that still applies too, so still available. Now, what we're sort of seeing now is, we've got a $5 billion turnover, $50 billion turnover. The $150,000 concession, I think there was a $500 million turnover in there. So we're still stuck with this concept of turnover tests and what are your affiliates and associates, and do you have to take into account offshore, etc. So the complexity and problems around that will persist, unfortunately. I do know that the government has a number of incentives and programs to encourage manufacture in Australia, but I suppose I pose a question down the bottom there. It's a lot of money the government's spending, and long term it might be good for the economy. Having regard to the theme or the mantra of last night's budget, I'm not sure how many jobs this creates in the short term, certainly not in Australia. Second one worth noting is the carry back of losses. A number of companies do have these types of rules. We did have them for a very short period of time, about 10 years ago. Interesting to note, this is only for incorporated businesses. So if you're running your business through any other structure, you do not get the benefit of this change. Secondly, there's a 50 billion turnover test again, so most of us will be in. And the way it works is if you make losses in FY 20, 21 or 22, you can carry those losses back and get a refund of tax that you've paid for FY 19 or subsequent income years. So to try and explain that, if you had a loss in the FY 20 year, you'll go back and get a refund of your 19 tax payments. If you had a loss in the 21 year, but not the 20 year, you could go back and get a refund for the 20 year or the 19 year, depending on the size of the loss. The other proviso is you can't push your franking account into negative. So if the business has already distributed profits and you don't have a large franking account balance, it will be a very limited value to you. Down the bottom of this slide, once again, I've asked two questions. Both of these initiatives, they rely on tax returns being lodged, claims being made into the future. And you can see by the forward estimates, these blow out sort of 2 or 3 years into the future. So stimulus is not immediate. There's a little bit of time before these kick in. And lastly, I ponder how these two rules would apply together. Is this a situation whereby a company that's marginally profitable or even in small losses can go and spend large amounts on assets, take the write-off, push themselves into large losses, and actually carry those losses back to earlier years to get refunds to effectively fund the assets they've just purchased? I suspect the answer to that is yes, but we'll wait and see when we see the law. A couple of other things I'll briefly touch on before I talk about the personal tax cuts. There's been a fair bit of confusion and conjecture about the implications of a case called Bywater case. And this deals with the residency of companies that are incorporated offshore but have operations or activities within Australia. They are going to clarify this. So the new rule will be if a company is incorporated offshore, it will only be taken to be an Australian resident if it has a significant economic connection to Australia, which means you need both core commercial activities and central management and control in Australia. So what the government here is doing is they're focusing on two tests, an operational test and a control board-driven test. Core commercial activities, I'm not sure what that means. So we do need a little bit more clarity, a bit more work around that. But it is good to see the government clarifying this and making it clear that you need both operational and control in Australia to be taken to the Australian resident. The bottom of that slide, I'll just, a couple of observations. So the government is expanding the number of jurisdictions in which it has exchange of information. In the budget papers, they do note that this is beneficial because foreign investors that are taking advantage of the MIT regime and getting 15% withholding rather than 30%, there's more countries from which they would come. It's an interesting list of countries, so I'm not sure whether the investors are actually in those countries or they're conduits, but that's, I suppose, another question. But the other thing I read into it is by extending the information sharing treaties to some of these countries that might be viewed as tax havens, what we're seeing is a greater level of transparency and cooperation globally. I'll move lastly on to the personal tax cuts. So what the government announced previously is that there'd be stage 1 tax cuts, which we got last year, and there are a number of offsets in that. There was stage 2 and stage 3. There was some speculation that both stages would be accelerated. That is not true. Stage 3 has not been accelerated. It is unchanged, and we will get that from 1 July 2024 as originally planned. Stage 2 has been brought forward, so these changes will apply from 1 July 2020. I'll come back to this slide in a minute, but if I just roll forward. So that's a diagram explaining what we have now is the yellow one. The blue is what we're getting from 1 July 2024, so that has not come in or been brought forward. The orange one is what has been brought forward. And what you'll see there is they haven't actually changed the tax rates. They have just changed the taxable income thresholds at which the rates cut in. So if you compare the orange and the yellow, tax-free threshold is still $18,200, unchanged. The 19% tax rate used to cut out at $32,500. It will now go through to $45,000. The 32.5% rate will pick up at that point, and rather than cutting off at $90,000, that will go through to $120,000, and then the 45% rate kicks in at $180,000, as it always has. Going back, what that means, when you do the maths, it means that if you're earning an income of $40,000, the saving is in the ballpark of $1,000 a year, so about $20 a week. If you're earning $120,000 a year, it's $2,500, so about $50 a week. Our understanding is that you won't be getting refunds of the PAYG that's been withheld since 1 July, but what the tax office will do is issue updated tables, and on the first example, instead of giving you an extra $20 a week in your pocket, it might be an extra $30 a week, so that by the time we get to the end of the year, it's all caught up and you've got the $1,000. I will now hand over to Nikki Purser, who leads our R&D team nationally. I hope that's right. Nikki is there. I can see Nikki. It's all yours, Nikki.
Great. Thank you very much, Neil. As Tony said, our research and development is back in black, I would say, although we've been told that back in black is dirty word these days. Goes to a little bit of the history of the research and development over the last few years. You may remember that Malcolm Turnbull came out with the innovation agenda, and then the LNP, or the Liberal government, discovered that innovation is actually a bit of a dirty word, and that people associated innovation with losing their jobs. Then it became, there were a couple of bad behaviour in the R&D space, which led to Scott Morrison calling the R&D scheme a rort. So that didn't do us any favours. In 2018, a bill was introduced to rip out $1.8 billion from the scheme over the following 4 years. That bill went through a Senate inquiry, which said go back and rethink. The government then, just before Christmas last year, tried to reintroduce that bill, and they hadn't really rethought. So it went to another Senate inquiry, and the report from that Senate inquiry has now been delayed 4 times, purportedly to next week. All through this last 6 or 8 months of COVID, you know, we did feel that the government may be changing its position with regard to research and development. Although Karen Andrews, as the industry minister, was pretty adamant that there would be no change. The first real hint we got of a real change in philosophy was last Thursday, when Malcolm Turnbull gave his speech regarding the changes, or the implementation of the modern manufacturing strategy, and where he mentioned a couple of times that we could look out to Tuesday night to see changes to the R&D tax incentive. In the background of all of this, because the bill was proposed to backdate to 1 July 19, there's been a lot of uncertainty in the space. That, coupled with the ATO and Oz industry being in the past a little bit aggressive, probably on the back of some of those comments that were made by Scott Morrison, it really has made you know, people back away a little bit from taking advantage of the R&D tax incentive. So just to sort of cut to the chase as to what the bill, or what the proposed amendments to the bill were announced in last night's budget. So basically, they're sticking with the structure of the current bill that's before the Senate, but looking at some amendments to the thresholds and rates of assistance to really encourage companies to undertake further R&D activity. So changes to the bill, which will now be effective from 1 July 2021, rather than backdating to 1 July 19. So they have retained the much maligned intensity measure, which is designed as a means to provide variable rates of assistance to large companies. But they have made it down to 2 tiers, and they've made it a lot more attractive. We will say that we're still a little bit disappointed of having that intensity measure in the fact that it does favour some industries above others, and the point of the tax incentive is that it is industry agnostic and not the government picking winners. The refundable offset rate will actually effectively remain at 43.5% for the 2020, 21 and 22 financial years. And they achieve that with the falling company tax rate by increasing the incentive component to align with the corporate tax rate. And the other good news is that they're removing the proposed $4 million cap on the refundable offset. So you can now, no matter what you spend on R&D, if you're entitled to the refundable offset, you get that amount of cash back at the 43.5% rate. So I might just move to the next slide. Just in terms of other changes, so the legislative changes themselves make no change to the definition of R&D, etc. It really just changes to the rates of benefit. They do increase the total expenditure cap, so if you're lucky to be in this position, you can now get the offsets of up to $150 million of R&D spend rather than $100 million. The actual substantive changes in terms of what the benefits are to companies amount to about 4 pages of the new revised bill that came out today, and then there's about 30 pages of consequential amendments and fairly technical amendments that the R&D community will get excited about, but most taxpayers won't need to take too much notice of. But one of the things in there is that they've gone back to that position of publishing companies' R&D spends. And there's some consequential amendments to the Industry Research and Development Act as well. Just going to what it actually means for companies. Just on the next slide. So for 1 July 19, it's status quo. Companies who have lodged their 2020 tax return, they do not need to refund the government, as was talked about in the Senate inquiry. It stays at the 43.5% refundable offset and the 8.5% effective rate for the non-refundable offset. For 2020, with the slight reduction in the corporate tax rate, the offset rate for the refundables remains at 43.5%. Company tax rate coming down to 26% means net benefit of 17.5%. If you're non-refundable, depending on whether your turnover is below 50 million or over 50 million, it's either at 12.5% or 8.5%. So when getting to the good news in 2021, which is on the next slide. So the refundable offset rate remains at the 43.5%, but they achieved that by putting into the legislation that the offset rate is 18.5% above the company tax rate. So the company tax rate coming down for companies under 20 million to 25% in that year creates that 43.5% refundable offset that gives you that cash in the dollar. And then keeping the tiered system for the non-refundable, we've moved to 2 tiers. So for the first 2% of total expenses, and I must say there was an error in the budget report we put out last night and it said 2% of annual turnover, 2% of total expenses, then the rate of 8.5% incentive will remain. Anything above that 2% will then be at an additional 8%, giving you 16.5% incentive rate on anything you spend on R&D. If people do have questions afterwards in the sessions, I think people are going to talk a little bit further about the manufacturing, the modernisation strategy, and also with regard to export market development grants, the changes to those. So I'm going to hand over now to Mark Molesworth to take you through some of the other tax changes. Thank you.
Thank you, Nikki, and good afternoon. Thank you for coming along to this session. I get to talk about some of the concessions that the government loves to give away. That is, concessions that sound really good when the government announces them, but really don't cost the government much at all, either because they're giving exemptions from things that companies and other taxpayers never actually pay tax on anyway, or that the dollars involved are so small that in the context of a $27 billion instant asset write-off, the extra money being given away through these concessions is very little. One of the big ticket items that was announced by the Treasurer last night was that he was going to increase the turnover threshold for the definition of small business entity for certain concessions, certain small business concessions, from its current level at $10 million of turnover annually up to $50 million of turnover annually. Now, what that actually gives you access to, those companies and other taxpayers that are currently in that $40 million gap between $10 and $50 million, when you look at it, actually isn't that much. So from the 1st of July 2020, companies in those circumstances and other taxpayers in those circumstances get to take an immediate deduction for their startup costs and for certain prepaid expenses. Those don't usually amount to a lot. The most exciting change from our point of view is that from the 1st of April 2021, the small business exemption for car parking in the FBT Act will become available to entities with a turnover of up to $50 million. Now, that is a good outcome because paying FBT on car parking is one of the deadweight costs of business at the moment. So that is probably something that is worth writing home about. The other exemption from FBT from the 1st of April 21 for these taxpayers is for the provision of multiple work-related electronic devices to employees. Again, that's not taken advantage of a lot, and there's not a lot of dollars in that concession. From the 1st of July 2021, there are then some administrative concessions that these businesses will get access to. Again, these are administrative. They are not going to save any taxpayer a huge amount of money. Getting access to the simplified trading stock rules, how you calculate your pay-as-you-go instalments and your GST calculations are really not going to give a lot of benefit. The one concession there that may be of interest, particularly if you get into a dispute with the Commissioner of Taxation, is taxpayers with that up to $50 million turnover will now be eligible for the 2-year limited amendment period, as opposed to the ordinary 4-year limited amendment period. However, it's only taxpayers who are intending to have a dispute with the tax office that should be happy about that, and I'm not certain any of us are ever happy about having a dispute with the tax office. On my next slide, there are some extra concessions which have been provided to all taxpayers generally. Again, most of these are the type of concessions that governments love to give because they're concessions against taxes that most taxpayers weren't paying anyway. The FBT exemption for retraining and reskilling staff, technically there might be an issue there if you retrain someone before you deploy them to their new position, but if you retrain them after you've already deployed them to their new position, there's really no exemption there to give away, and most companies were smart enough to redeploy before they're retrained. The reduction in record-keeping obligations will be welcomed because it will allow us to not necessarily comply with the very detailed documentation that the FBT Act currently says we have to keep. However, this is all subject to the Commissioner of Taxation putting out guidelines on what ordinary business records will be acceptable in substitution for those declarations. We haven't seen that detail yet. We hope that the Commissioner of Taxation is going to come to the party and give this change in law the meaningful operation that it's intended to have. And then finally, there is a removal of the capital gains tax implications for the granting of rights to live in granny flats. So if you're like me and you have elderly parents, if I choose to put up a granny flat in my backyard, I'm then put, at the moment as the law stands, put into a bit of a cleft stick, because either I cannot have a formal agreement with my parents about how long they can live in that granny flat, which means they've got to be nice to me for the rest of their lives if they want to keep living there. And if I do that, then I probably don't damage my capital gains tax exemption on my main residence. However, if they're smart and if they put in place a written agreement with me that says they get to live there even if they're nasty to me, and then we enter into that formal agreement, then I probably damage my capital gains tax exemption for my main residence. What the amendment to the law is intended to do from the 1st of July 2021 is to make the entry into those agreements not cause capital gains tax to apply where it otherwise wouldn't. And it will apply both for elderly people and for people with a disability. Finally, on the last slide, I want to talk about one of the key announcements that was made last night in relation to JobMaker. So there's a JobMaker hiring credit which is available to employers who increase headcount by hiring workers who are currently on JobSeeker, currently on the dole. And if you do increase your headcount and you hire someone aged between 16 and 29, the government will subsidise their wages by $200 a week for up to 52 weeks. And if they're aged 30 to 35, by up to $100 a week for up to 52 weeks, so up to the first year that you employ them. Why the government chose to cut this off for employees up to age 35 when there is good evidence that there are a large number of long-term unemployed people over that age is a matter that you'll have to take up with the government. It does tend to look like something that if we tried to do in business, we would get into a whole lot of trouble for. Finally, there's the apprenticeship wage subsidy. Now, this already existed, but it only existed for small and medium enterprises. What the announcement was last night was that it was being opened up to all employers. So all employers in Australia who take on new apprentices or new trainees between 5th of October and the 30th of September 2021 will get up to half of their wage subsidised by the government. There are some caps. There's only 100,000 of these new placements available to be subsidised, and the maximum subsidy is $7,000 per quarter or $28,000 a year. But if you can stay within those bounds, then that may be a really good benefit to taking on new apprentices and new trainees. That's where my presentation ends, and you now have the great privilege of listening to Michael Pascoe. Michael is one of the most respected and experienced finance and economics commentators in Australia. He's had 4 decades in the media across print, broadcast and online, including spending 18 years as the Nine Network's finance editor. I give to you Michael Pascoe.
Thank you very much. I consider myself given. Look, 2020, as we all know, I just don't come anything like it. I came back to Australia in 1979 and joined the Fin Review. So 1980 was sort of the first budget that I took a fair bit of notice of. There's a lot of budgets, 40 years. Another 3 years, and from then on, 37 years, I've taken a lot of notice about budgets. It's the night you don't sleep. Of those nearly 4 decades of budgets, the jump, the change is unbelievable. It's something that could only happen in 2020. And I thought, well, the coalition era that we're presently in, the Abbott, Turnbull, Morrison period, what could illustrate the change in this, the 7th budget of that era? So let me remind you of something that Joe Hockey said. He's not quite as much a fan as some.
I call the Honourable the Treasurer.
Yes, Michael Pascoe is so respected that he wrote a few days before I put $8.8 billion into the Reserve Bank, he wrote that I was going to rip money out of the Reserve Bank. That's how good Michael Pascoe is. That's how good Michael Pascoe is. So if you're taking economics lessons from Michael Pascoe, I'd suggest you go back to...
And the missing word there is Swanee. Not go back to school, but go back to Swanee. Just for the record, you are welcome to Google Michael Pascoe, Sydney Morning Herald, $8.8 billion Reserve Bank. You'll see that I did not write that he would rip money out. I wondered if he'd rip money out. I had no idea he had a cunning plan, because what he actually did back then was borrow an extra $8.8 billion under the Labor budget he inherited, whacked it into the Reserve Bank so he could then suck out much bigger dividends on his own budgets. Cunning plan, Joe. How times have changed. $8.8 billion. The Reserve Bank didn't ask for the money. Treasury didn't advise him to do it. But Joe thought that they needed to beef up the Reserve Bank Reserve Fund. Well, where are we now with monetary policy? Where are we now with moneyarama at the RBA with Philip Lowe? How things have changed. So far, since March, since it was announced, the Reserve Bank has bought $63 billion worth of government bonds and is counting. It's open-ended, whatever it takes to keep the 3-year bond rate at 0.25%. They are also throwing money at every ADI. Every bank, every building society, every credit union can borrow from the Reserve Bank for 0.25%. So far, 81 billion has gone down there. Another 120 billion is available if they want it. Of course, the catch is someone's got to want to borrow it from them. They are more than doubling their balance sheet. There may be another tiny rate cut. Actually, it's a bit hard to call it a cut, to go from 0.25 in the cash rate to 0.1. Let's call it a filing, getting out the emery board to just shave those last few points. And because the Reserve Bank is at the end of its monetary piece of string. It really has done all that could be reasonably expected of Reserve Bank, and it was doing it before COVID hit. To quote Joe Hockey again, when he was Shadow Treasurer, they're not cutting interest rates because the economy was strong, and they were cutting interest rates before COVID. So they really didn't have much ammunition left on old-fashioned monetary policy when the disaster struck. And that Reserve Bank Reserve Fund, it's sitting pat at 14 billion, and no one is talking about it needing to get any bigger. So with the Reserve Bank having gone as far as it wants to go, okay, maybe another 15 points, and what difference does that make to anyone? But maybe another 15 points. Certainly a lot more buying of government bonds. What do? Well, they do what they've been doing for a while now and saying, hey, it's over to you, Josh. Come on, make with the money. Well, perhaps the most important thing a journalist has to do on budget night is to come up with a catchy phrase for what you're going to call the budget. I had a minority opinion, it seems, last night, but for me, it's the Whirling Dervish budget of 2020. Why the Whirling Dervish budget? Well, if you know your Whirling Dervishes, you will know that the whirling is about a mixture of obviously spinning, but also faith. And Josh's mix is certainly spinning and faith. A great deal of faith is called for with this budget. First of all, faith that there is going to be a vaccine next year, because otherwise the figures go awfully astray thereafter. There is enormous amount of faith that we are going to rush out and spend this lot of tax cuts, unlike the way we didn't really rush out and spend our last lot of tax cuts, if you remember retail sales in the wake of the last tax cuts. There's also faith that having 1 million fewer Australians will barely matter. Think about that for a minute. Most of Australia's GDP growth for the last several years has come from population growth. The budget's saying we're going to have 1 million fewer Australians compared with the projection last year at the end of the forward estimates in 4 years' time. Immigration's collapsed, actually forecast to have a net loss of people this financial year and next. And our fertility rate has also been falling away. The government finally fessed that up. It was one of the biggest scams of last year's budget, that Treasury was either pushed to or was grossly incompetent in figuring all of its forecasts on the idea that we were on our way to have a higher fertility rate. It's nonsense. And the biggest leap of faith is that the world will be a nice place and we'll all live happily ever after. Because that last leap of faith is what's required for the last 2 years of the forward estimates. I've lifted this chart straight from the budget papers, and this is, look, economists at the Treasury have been verbaled by this. As I have to remind people every year, forecasting is a mug's game. Everyone hates doing it. Treasury only does 2 years worth of forecasts, this financial year and next financial year. The next 2 years are not forecasts, they're projections. And the projections are based upon assumptions that are kind of laughable, because they come down to the idea that we will return to trend, that we will absorb all excess capacity over 5 years. Now, if you assume that, of course you end up with the figure out in 2023-24 of 3% real GDP growth. How can you get that sort of growth when you're not getting population growth, or rather by then your population growth is still suffering from what you missed out on? It's a bit of a nonsense, but that's not really a forecast. Before I leave this graph though, have a look at the wage price index. The biggest domestic problem for the Australian economy for the last 7 years, coincidentally, has been a lack of real disposable income growth, which has fed into weak consumption, which is why the economy was not strong before COVID. The forecast for next year is that we'll have a CPI of 1.5% and a wage price index of 1.5%. In case you've never actually sat down and done the numbers, if there are no tax cuts that year and you give your employees the CPI as their wage rise, you are cutting their living standards because their real take-home pay is not 1.5% bigger. The taxman steps in and they go backwards. Okay, this year, the best guess, well, I think it's be optimistic that we get 1.75% CPI. Wage price index of 1.25%, well, yeah, we'll see what happens there too. But because of the tax cuts, those who are lucky enough to have a wage won't suffer a fall in living standards. As far as those Mickey Mouse happy ever after Goldilocks projections out in 22, 23, 23, 24 of a wage price index growth of greater than the CPI, tell them they're dreaming. So what about the actual forecasts? The key here I want to point to is household consumption. Household consumption makes up the majority of the economy. It's believed to be contracting by 1.5% this financial year. And then the government, as an enormous act of faith, is telling us it's going to soar by 7%. Now, it's going to soar by 7% when on the preceding page we saw that the unemployment rate is going to be around 7% for most of that year, if we're lucky. We saw on the preceding page that real disposable income is going to be going backwards. But all of a sudden, households are meant to be spending like they're not living in uncertain times. Pull the other one. There's a lot of rhetoric around, God, if you've read Chanticleer in today's Fin Review, about this being a business investment budget. This is all for business. It's highly ideological. Well, business isn't participating terribly well. Non-mining investment has collapsed. Down 3.7% last financial year, expected to be down another 14.5%. So call that what? Call it 19% collapse in business investment, non-mining business investment. It's only expected to rise by 7.5% from that lower level next financial year. So for all the money that's being thrown at businesses, all the rich potential for rorting various incentives, did I say that? All the potential for making the best of your close relationship with a very able accountant at BDO, only going to get 7.5% growth in business investment. That's appalling. Where's the jobs growth in this? Wasn't this meant to be a jobs budget? Well, this is an act of faith. One of the other peculiar things that again requires a huge act of faith is a key forecast about what's happening to revenue. As you can see, revenue is dropping quite sharply as spending skyrockets, hence the headline deficit, debt, and all the rest of the stuff that people talk about when they've got nothing else to talk about. But the funny thing about this is that an act of faith, the government believes their tax receipts will fall by less after the biggest economic shock since the Great Depression than they did after the GFC. Callum Pickering fingered it quickly last night. GFC tax receipts fell by 3.7 percentage points, and the government's claiming they're only going to fall by 2.4 points this time. That would be indeed astonishing if it was achieved. So that's the acts of faith that are being called for. The other part of the Whirling Dervish, the most obvious part, you would think, is the spin. And this is where I thought it was the most extraordinary budget I have ever looked at. I have never seen such outrageous spin by a treasurer, and sadly, most media fell for it. Watching the speech last night on television, I didn't know whether to laugh or cry when Josh Frydenberg said that compared with the tax you paid in 2017-18, you're going to have this wonderful big tax cut. And I thought, well, surely he misread. You know, he didn't mean compared with what you were paying 3 years ago. Surely not. I mean, why stop there? Why not compare it with 1960? You get a much bigger tax cut if you do that. Oh dear. But that's what was said, and that's what most media dutifully parroted as an example of the extremely good media management this government enjoys. What's the reality? The reality is that it's nonsense to compare this year's tax cut with what tax you were paying last year. Because if this is meant to be about stimulus, if it's meant to be about jobs, the impact will be the change this year on last year, as everyone knows. Well, it's not a 21% deduction for someone on 40 grand, as already pointed out, it's a lot less than that. And the biggest trick of all is that it's not the phase 2 of the tax cuts that are providing that grand or so for the vast majority of Australian workers. The median full-time wage in Australia is about 60 grand. So the grand or so for the person on 60 grand is not coming from phase 2 tax cuts, because the government has extended its low to middle income tax offset for a year. Note, they've extended it for a year. They haven't built it in, which means that next year, most Australians will actually have a tax increase. It doesn't make sense. From an economist's point of view, talking to one today, they say there's an indication that people are more likely to spend a tax cut if they believe it's permanent. If you get a windfall at the moment, you're more likely to save it. Well, most Australians, if they wake up, will realise that grand is a windfall. Does it make sense? Of course it doesn't. But this is not a budget without ideology at work. Who gets most of the benefit from phase 2 tax cuts? Who gets all the benefit, really? Those who are on 6 figures. Thank heavens they at least didn't pull forward the stage 3 tax cuts. I've stolen these couple of graphs from Greg Jericho at The Guardian. He does a very nice job with the graph, unlike me. And he was one person who was not fooled by the spin. As you can see, phase 3, when it turns up, your person on the median full-time wage is getting a less than a 1% deal. If you're on 200 grand, you're doing nicely. Another example of the spin. Oh, I love this one. Sometimes gifts fall into your pocket as a journalist if you're half awake. You might remember Josh saying that there was $14 billion in new and accelerated infrastructure projects. Really? Well, the first 2 examples he gave of it were the Singleton bypass and the Bolivia Hill upgrade. I quickly checked. Here's Bolivia Hill in 2018. The local member, one Barnaby Joyce in the middle there, looking very handsome in fluoro. 2018, they have been shoveling and grading and whatever on Bolivia Hill already for 2 years. The Singleton bypass, folks, it's not going to start construction until the middle of 2023. I think it's a rather unfortunate symbol of a lot of the talk about the government's infrastructure spending, that the first 2 examples they give, one is 2 years old and the other one doesn't start for 3 years. But infrastructure has long been a favourite area to play in if you're a spinmeister. It was started by Smoke and Joe Hockey back in 2014. He set a standard that the government has now adopted throughout its announcements. This is primarily the government of announcements. Think of a large number, add up the number of years you need in spending to get there, and you get a headline. Joe did it in 2014 when he announced a record government investment in roads and rails and infrastructure for transport, $50 billion. Fine print was over 6 years, worked out at $8.3 billion, which was actually a reduction in what the previous government at the time was spending on infrastructure. Well, anything Joe could do, Stunt Morrison as Treasurer could do more. $75 billion, a 50% increase, bracket over 10 years, which meant it was really another decrease, $7.5 billion. For a little while last year, I thought Josh Frydenberg had turned the corner. He announced $100 billion over 10 years. So 10 billion looked like a real growth figure. And last night, here's the catch, folks, that $14 billion, he stressed, was part of the increased 110 billion over 10 years. So the government has actually only increased its commitment to transport infrastructure by $1 billion a year. It is trying to pull forward a bit of spending. It hasn't been really good at that. You might have seen the story that Channel 9 had on the congestion busting $400 million promised in the last budget, the last election. They've only managed to spend $140 million. But anyway, here you've got an increase of $1 billion a year. By comparison, New South Wales alone is spending $90 billion over 4 years on that sort of transport. And the thing about the construction industry, the big ticket items, is that there is inflation if you're building a railway or an overpass. So $8.3 billion in 2014, if you allowed 2.5% as your average construction inflation, by the middle of Josh Frydenberg's decade, it's going to be worth about 10.7. So really, there's no real increase in infrastructure from Joe 7 budgets ago. The thing about a lot of the infrastructure talk is that it's already happening anyway. In fact, for big ticket items, the ones that politicians particularly like, the industry is pretty much running at capacity. We already had locked in, primarily through state government spending, a huge surge, thank heavens, because it is really holding the economy together, in roads, highways and railways. Big ticket, filling in some of the gap in the fall off in housing that was already happening before COVID. This is a very messy graph from Macro Monitor. I'm sure BDO will somehow or other get you a copy if you want one. What it shows, if you can follow that transport infrastructure orange line in the bottom, is that it doesn't actually increase by very much. There's actually not a lot more money going in on top of the spend. Residential building is coming right down. The dotted line is what Macro Monitor was expecting before COVID hit. The solid line is what they're now saying. Social building, the thing that every economist and his dog was calling for as a good way of spending money to create jobs. It's got a mention in the budget, but it's really not much happening there. On the big ticket items, don't you love a colourful graph? Macro Monitor, what a great job you do. These are the big ones, those that involve more than $300 million spending in every single year. It's colour-coded. Always popular with the spreadsheet in Canberra these days, apparently. As you can see, the states with the money, very much New South Wales and Victoria, followed by Queensland. All that blue is keeping New South Wales ticking in a lot of key areas. Similarly, Victoria's got projects underway that are locked in and are happening, and this is prior to COVID. It also means there's really no capacity in the major construction industry to do much more. If the government's smart, and there was an indication of it in the couple of billion they're talking about giving to states on a time-limited basis, if the states are smart, they'll immediately flick that to local government to do small local projects, which would achieve some make work good, and if local government is smart, achieve more than that. But in the big ticket stuff, Queensland's doing a bit, and then it gets awfully thin for the remaining states, which is a shame. You know, a lot of treasurers like to do something to mark their budget, you know, some sort of an event. We had Joe Hockey and Matthias Cormann smoking a cigar outside their offices. That certainly marked one budget. My offer to Josh to mark this budget, I'll pay for it. If you'd like to have this tat done, I think it'd be a great way of marking it down, because it is the Whirling Dervish budget. In big numbers, it's necessary. It's vital. It has to happen. No problem with those numbers. No problem with the debt involved. Guy DeBell from the Reserve Bank spelt this out beautifully a week or two ago when he explained that if you don't borrow big now and go into debt big now, you will actually end up with a bigger debt down the track. There is no option. If you're worried about saddling the next generation with debt, tell them they're lucky we're doing it, because if we don't, they will have a worse economy and more debt when the time comes. But are we getting our best bang for the buck from this budget? As you've already heard, there are a whole pile of generous deals going for business, and I think this is quite ideological. The government has accepted, if you saw the interview with Lee Sales last night, Josh Frydenberg couldn't quite be honest and admit that, yeah, all that stuff for the past dozen years about Labor's debt and deficit was just a political lie. They've accepted the need to spend. There's no option. But how they're spending is quite ideological. Money for business, and particularly the way a lot of this is being targeted, is really aimed at businesses that are pretty secure now and are secure about their future. It's a big opportunity for them. How much of this spend is aimed at businesses that are on the edge? The tax callback, yep, that's great. That looks like a good policy. But will it end up being rorted, and how much good will it do? Will it in fact entrench the better businesses? Will they grab the opportunity and seriously invest, seriously employ more people? I hope so. We're taking an enormous gamble on it. You may have heard that from the press gallery, there is a lot of chatter around Canberra that the government is considering an early election, calling election next year, 1 year early. A couple of things about that. You don't call an early election if you think things are getting better. The spending that's coming out now will come on top of a natural bounce back. As the restrictions are lifted, yes, our economy does bounce back. There is a pent-up demand. It will come out. If you're looking at political history, and that's the first thing politicians tend to do, you can rely on recessions to change governments. The last two we had did. Fraser in the 80s, Keating in the 90s, okay, he got a 3-year extension thanks to John Hewson's birthday cake, but the recession did him in. How will this government escape that sort of a penalty if we are too slow in getting unemployment down? The Whirling Dervish. How long can it keep spinning for, facing a lengthier recession than we need to feel? Thank you.
Okay, thanks, Michael. That's certainly a unique way of explaining our budget. I've never heard of a Whirling Dervish, so I learned something today. So, but thanks very much for your insight and your time today. It certainly gave us all some ideas about where the issues might impact on us all personally. So, in terms of the BDO team, again, thank you for your time today. Nikki, Neil and Mark, you've come along, give us your insights, and I'm sure a lot of our clients will go away today knowing a little bit more about the implications on them personally, and that's our role. I'd ask everyone to stay around and invite you to stay around for our next session, which is all the state-based sessions. So in this session, you'll join up with each of our teams in each state. I think you go to the left-hand menu, pick the state that you're in, and then you go to that. And then you'll be joined by the BDO team, which will then go through implications in your state. And then wrapping up, there'll be a Q&A session. So plenty of opportunity to raise specific questions if you've got some about your business. And as always, if you're not covering them there, please reach out to anyone in the BDO team. We're very keen to explain and help you understand and digest what this all means for you particularly. And thanks for coming today. Thanks for attending. We always like to see big attendances. I think we're almost a record attendance. And I certainly look forward to welcome you to our next event in the not too distant future. Thanks a lot.